Hi everyone, welcome back to my channel. My name is Eve, and on this channel we are talking about everything regarding financial literacy and increasing our literacy. Today we'll be talking about the different types of mortgages available. Whether you're a first-time buyer, so you've never bought a house before and this will be your first home purchase, or you're just remortgaging the house you already live in, these are the types of mortgages that will be available to you. So um, the first type of mortgage is what's called a fixed rate mortgage. And the clue is in the name. It's fixed. The rate is fixed throughout the initial period. Okay. So a fixed rate mortgage will either be 2 years, 3 years, 5 years. You can go even like 10 years if you choose to. And during that initial period, the rate is fixed. The pro with that one, therefore, means you've got predictable monthly payments. And if the rates go up or if the rates go down, you don't have to suffer that. So it's really good for planning your life. You always know this every month, this is the payment I will be making throughout the initial term. The cons with them is that when you're in that fixed term, there's less flexibility. You can't just decide after 3 months, oh, life has changed, so I'm opting out, I'm changing. You would have to pay a penalty if you wanted to leave that mortgage. So that's one of the cons, that there's less flexibility, and you would have to pay early repayment charges in those cases. The next type of mortgage we will be discussing is what's called the tracker mortgage. So that's the tracker mortgage. With the tracker mortgage, it tracks the Bank of England base rate. So Bank of England base rate. So which usually, and then what it does is they add like a small percentage on top of that. So if the Bank of England base rate is say 2%, if your tracker is 1% above the Bank of England base rate, you will be paying a rate of 3%. So it tracks the Bank of England base rate. So the pros of this are, if the rates drop, so if the Bank of England drops the base rate, which they sometimes do, I think it happened a few years ago when they were trying to combat combat inflation and stuff, they dropped the rate, and in that case, your rate will also drop correspondingly, which means that you'll end up paying less. So that sometimes can work out, and it's all obviously very transparent. The cons with this kind of mortgage, the tracker mortgage, is that if interest rates go the opposite way and they go up, your mortgage rate can also go up. So your payments can suddenly become quite unmanageable if they go up too much. And because it can go up and down, you can't predict what your monthly payments will be. It just depends on what the rate is. So fixed rate mortgage, tracker mortgage, and then the third mortgage we'll be talking about today is the standard variable rate. So that's standard variable rate. And you tend to find this shortened to SVR on a lot of websites. This is actually your lender's default rate. Okay, so once one of these, like let's say the fixed rate or the tracker rate mortgage, when those deals end, it automatically defaults to the standard variable rate, and it's usually quite a much higher rate than you were paying before. The pros with this one, though, are there's a bit more flexibility. So if you decided after 3 months or 7 months that you actually wanted to change and you wanted to move away from this mortgage, there's no early repayment charge. You can just leave. So it's quite flexible. The cons with it, obviously, other than being usually more expensive, is it's also unpredictable. The next kind of mortgage is what's called the discount variable rate. So that's discount variable rate. This is a variable rate mortgage that gives a discount on the lender's standard variable rate for a fixed period of time. So let's say the standard variable rate of your lender is 6%. The discount variable rate might be 1% below the standard variable rate. So you would then pay 5%. So usually during this time, you would have lower initial payments. And it's really good if you believe that rates will remain basically stable, or the negative is being a variable rate, it can change at any time and can increase suddenly. And it's also harder to budget because of that. The last type of mortgage we'll be discussing today is what's known as the offset mortgage. Offset mortgage. This is quite an interesting type of mortgage, but it uses your savings account. So you would have a savings account and your mortgage account with the same lender. So what you do is you only pay interest on the difference between the two. So if your mortgage is, let's say, 100,000, but your savings are 20,000, you only pay the interest on the difference. So in this case, you would only pay interest on 80,000. But the good thing with this is you can keep your money separate. What people don't like doing sometimes is using their savings to pay off their mortgage, just in case they need the savings at some point. Sometimes life is a bit unpredictable, so they want to have access to those savings. This way, you still have those savings, but the lender will only charge you the difference in those interest on the difference between your mortgage amount and your savings amount. So you save interest without touching your savings, and it's flexible and it's tax efficient. The con with this is you tend to need quite a significant amount of savings for it to be worthwhile. So if you had £500, really, it's not going to be that much of a game changer. So those are the different kinds of mortgages available. But what about the actual process? You found your house. Let's say you're a first-time buyer. You found your house that you like. What do you do next? Well, before you went out looking for a house, you would have gone out to your lender first and gotten a mortgage in principle, which would have given you an idea of the amount of money they would be willing to lend to you. So now you've got your actual house, you go back to your lender and say, this is my house, this is what we agreed. And then they now go through the process of where you're discussing with your mortgage lender, and then they see what product they can offer you. If you're remortgaging, you would have already agreed on your product if you were a first-time buyer. As I said in my previous video, which might be worth you popping and taking a look at, about don't overpay before you remortgage, look at that video. I'll put the link below. Is do compare, just make sure before you sign on any documents that you go on like a comparison website, like Money Saving Supermarket or in something like that, just to make sure that you're getting the best deal for yourself out there. Okay, to just compare but remember to check like for like. So if you're looking at two-year fixed rate mortgages, compare with other 2-year fixed rate mortgages to make sure that you're getting the best deal for yourself. So then what happens next is they would then send out a survey, someone to do a valuation. When they come out, they value your house, or if it's a remortgage, they might and you're staying with the same lender, they might just do a desktop valuation just to see that the house is actually worth the money that you want for it. At the end of that, then you submit all your documents, and hopefully you will have a mortgage, and that will save you money and give you a home where you can start continuing your life and growing your wealth at the same time. Thank you for watching. And remember, if you found this video useful, please do remember to like or subscribe, and or even share with anyone who you think might benefit from this. And remember to write a comment if you've got any questions, and I will be sure to reply to you. Thank you for watching. Bye.